All right, what's up, everybody? Lots to get into today's video, so we're just going to go ahead and jump right into it. The S&P 500 is now on track for its worst quarter since Q3 of 2022 and only the second losing quarter since then. Now, this is also when the stock market bottomed, right around when the stock market bottomed in Q3 of 2022. But there's no surprise, really. This really shouldn't be a surprise after we've seen such an aggressive correction. And we've seen the biggest drop in US equity allocation on record in this period, right? So, big drop in equity allocation for US stocks, and also very sharp and aggressive decline in the market. And we're seeing plenty of short exposure, more than COVID actually. When you look at the US fundamental long short net leverage, these are the current levels that we're at right now. And it's just very aggressive, right? And that's why we're seeing such big swings in the market, right? We're seeing the stock market drop by 2%. Sometimes we're seeing a gap down over 1%. It's been a very fast and aggressive move to the downside. Now, things don't look great. Okay, there are a lot of things to be concerned about. We'll talk about those, and there are some positives as well. But the recent decline in semiconductor stocks points to a coming slowdown in semiconductor sales. Okay, when you take a look at the world semiconductor sales in blue here, now, this is lagged by 6 months, which is why, you see the blue line here hasn't gone down yet, but these two follow each other very closely. And if we're going to be seeing a slowdown coming in global semiconductor sales, well, we already know what that potentially could mean for Nvidia, right? And, if we start to see Nvidia continue to decline, and we start to see their earnings forecast and their earnings guidance and just their earnings reports in general showing a slowdown, the bears are going to come out roaring. All right. I can already imagine how that's going to go. But when you look at corrections versus uncertainty, there have been 53 10 plus corrections, 10% or more plus corrections in the S&P 500 since 1950. And historically, about 60% go on to decline by 15%. Okay. Now, notably, the economic policy uncertainty index continues rising in those cases, and we doubt policy uncertainty declines post April 2nd. So, what's really important there to me is that the economic policy uncertainty index continuing to rise in those cases where we do get a 15% correction. And it just seems like that's most definitely not going to continue rising. Everybody is just, constantly on edge with Trump and tweets and tariffs and just anything related to what the current administration has going on with their policies. A lot of people feel like there's not much certainty, not much clarity. So it's very possible that we're going to get a 15% correction, especially when you look at data like this historically. The it's a majority case, right? Roughly 60%. Now, the Fed would be much better off cutting rates as US tariffs start to transition their way into the economy. Do the right thing. April 2nd is Liberation Day in America. This is from Donald Trump. So, he's pushing the Fed. And if Jerome Powell probably doesn't start cutting rates, I wouldn't be surprised if he starts, signaling or basically suggesting that he's going to fire him and get someone in there who will cut rates. Now, news articles are playing up economic uncertainty. We're focusing on that. If you look right here with Trump, you can see many different cases in the past, right? We had COVID, but the economic policy uncertainty index is higher than it was during the global financial crisis, during 9/11 terror attacks. Not right there with COVID, but obviously that was an extreme situation there. But Americans are suddenly worried about losing jobs, right? I mean, this economic uncertainty is spilling over into the consumers. It's spilling over into your average, resident, and we're seeing the highest number of people since 2013. The percentage of consumers who believe there will be fewer jobs in 6 months. Now, the S&P 500 has experienced a median annual drawdown of 10% during the last 40 years. So yeah, we've seen this correction, but it is very common, and this is just showing you guys that this is, a median annual drawdown. Okay, so that's what we've experienced. It is likely that we do end up getting a 15% correction, but there's no guarantees if, we stop at 15% or even if we make it down there, the market could recover before then. Now, volatility in stocks is historically normal in all years. Again, this is kind of just emphasizing, what we see, right? We have the largest intra-year drawdowns in these little diamonds here, and you can see that there's plenty of times where there's big drawdowns, but the actual annual return in the solid blue bars is positive, right? And so here's where we're at right now. Things are looking negative, as the stock market has already declined, 10% this year. But we also have the possibility to rebound from there. We take a look at some more data right here. The S&P is now down about 10%. Okay, what's interesting here, right, is that 5% pullbacks evolve into 10% corrections rather quickly, which is less than 60 days, right? And we saw that, right? This has been a very rapid decline of 10% that we had in the market, but conversely, moves from 10 to 15%, from negative 10 to negative 15% are more protracted. And the majority, about 66% of those, take longer than 60 days to play out. So we may not see, you know, as quick of a move down as we saw with the 10% correction that we had in the market. If we are going to get a 15% correction, it could take until the summer, right? May, June is when we could, potentially get that 15% correction. Now, UBS had some good stuff here, right? And they were talking about what to expect. They expect volatility likely to pick up in the near term. Basically expecting the U.S. to announce tariffs on most major trading partners on April 2nd. Inflation data on April 10th could contribute to shifting Federal Reserve rate cut expectations. And then the first quarter earnings season begins in April, in late April. The direct and indirect effect on tariffs and trends in AI monetization will be high on the agenda and could increase volatility. And so what they are saying to do is to take advantage of the U.S. volatility, by, considering approaches to phase in and buy dips on broad U.S. Equities and companies featured on, their AI list. So, basically, be smart, be tactical, do some research, figure out, who are some of the leaders, potential future leaders, in the AI equity market. And then to go long longevity. So in their case, they're looking at, essentially healthcare, right? Looking for people to live longer, wealthier, and healthier lives. So they're looking at select pharma, medical devices, healthcare services, select consumer and financial services, and then select real estate. And then also to navigate the political risks, right? And so they're saying that, gold and silver can continue to benefit from this. Oil capital preservation strategies, those are some areas to look at as well, right? So that's some good stuff from UBS. Now here, I like this one a lot. Okay, this is another chart from 314 Research, but essentially what you're looking at is if there is a recession, all right, this is going to be your S&P 500 path in purple. Okay, so this is the 10% correction right here. And if we do end up getting a recession, you guys see we head lower and it's very messy and it's very extended, period sideways. But if we get no recession, it means that this correction is a very good buying opportunity, and you see the market recovers very strongly a year later. Now, this right here is going to be the McClellan's. So you have the McClellan Summation Index and the McClellan Oscillator here on the bottom. And I'm just showing you guys we do have, some signals to look out for, right? This is a bullish divergence that we've got. We've already experienced the bounce in the market, so this bullish divergence could have been behind the initial pop here. But this is something I'm going to continue to monitor, right? Many times there's been these divergences. We've either put in bottoms or tops in the market, temporarily, right? Over here, we had one, in October, right, of 2023, right, where the S&P 500 was in a downtrend making lower lows, but the McClellan oscillator here was making higher lows. And before that, we had some negative divergences that led to some sell-offs. And so, this is one that I'm gonna, keep monitoring and watching. If the S&P 500 does come down here and make lower lows, are we going to be able to keep higher highs, or I'm sorry, higher lows in the McClellan Summation Index and the McClellan Oscillator? That's a potential bottoming signal, right? And that's not the be all signal, okay, the McClellans, but it is one of them, right? And when you start to see multiple signals of a potential bottom, then you can have more confidence, right? So that is one of the ones that I'm looking at. We also have a signal here with the tips. So, tips you can use as a leading indicator for the NASDAQ 100, right? So we've got the tips on top. You see when the tips are making lower highs and and the NASDAQ is making higher highs in an uptrend. It's a leading indicator suggesting that the NASDAQ should pull back, and sure enough, we did. And then here when the Nasdaq's making lower highs, but the tips are making higher highs. So now we have a bullish divergence on our tips indicator here. It's basically just suggests that the Nasdaq should start rallying from there afterwards. And that's exactly what we got. And that's exactly what we're seeing right now. We're seeing a rally in the tips while the Nasdaq is in a downtrend right here. So these divergences can persist, right? Sometimes they last a short period of time before they play out, and sometimes they can persist and keep being divergent for extended periods of time before you get that move. But in terms of looking for some reasons for a bounce, we've got that McClellan bullish divergence. We've got one here on the tips. The TLT also can be a leading indicator for the U.S. stock market. If you guys have been watching my TLT videos for the past few years, you guys know that this is a really nice signal right here. And again, we have an uptrend here in TLT now with the downtrend in the US stock market, potentially suggesting that, hey, we should be getting a bounce sometime soon in the US stock market as long as this divergence stays true. Now, Tom Lee's got some good stuff about why his outlook is positive. So for the rest of 2025, these are some of his bullish cases, right? Gasoline slash energy down and long-term interest rates down. The ISM turned above 50 and small business optimism continues to improve. You got tax cuts and deregulation tailwinds in 2025. The tariff war has some end date, right? Which is hopefully not a global recession. And then $7 trillion of cash on the sidelines at a time when we saw record high degrossing by hedge funds and massive retail margin related selling. So those are some of the bullish points. We've also got some more bullish points here via Goldman Sachs, right? When you look at CTAs versus US equities, Goldman has CTAs modeled as buyers of US equities in all scenarios over the next week and month. And when you track the seasonal trajectory, March 23rd is typically a bottom in the seasonal trajectory. And then we start to see a little bit of an uptrend. Now, this is only via the last 5 years from 2020 to 2024. So it's not going back, extremely far and using a bunch of data sets, but it's basically just telling you guys that the seasonals are turning from a headwind to a tailwind. And so, what are some of the areas to look at during a recovery? Small cap junk works the best in a recovery, right? So what you're looking here is, junk stocks performance 26%, small cap 23%, micro cap is 22%, growth 22%, value 22%. So I mean, you see these all have some really good returns. But junk, some of your junkiest stocks, which makes sense because those stocks can fall 30, 40, 50%, right? So even though the recovery might be the best, it may not actually recover back to its prior highs, right? And back to its prior levels because of how bad the drop in some of those stocks are. So stuff like this can be a little misleading, I think to people. So you do want to consider that and keep that in mind. But if you do think that, hey, we're hitting a bottom, or whenever we do hit a bottom, you want to look for some, potentially high risk plays, where you can get high risk, high reward. Those are some of the areas that you can potentially do that in, right? Now, there's plenty of the places in the market right now, that are quote unquote, a good deal, right, or a good value. If you take a look at the S&P 500 forward PE ratio, we're basically sitting right at our 5-year average right now. So a lot of people that like to say the stock market's expensive, valuations are too high. We're seeing that, the forward PE ratio for the market in general as abroad is basically at its 5-year average. Okay. So that's not super expensive. Technology is trading below its 5-year average. Communication services is trading below its 5-year average. You've got energy right here trading below its 5-year and 10-year average forward PE ratio. Real estate also trading below its 5 and 10 year. You've got utilities trading below its 5 and 10 year forward PE ratio. And then you've got consumer discretionary trading just above its 10-year forward PE ratio average, but still, below its 5-year average. So all of these areas right here could be considered trading at a discount, or at a cheap valuation, or getting close to cheap valuations, depending on which ones that you're looking at, by comparing them to their 5 or 10 year averages. Now, this is another way to visualize the same thing. If you take a look at energy. Okay, energy is trading 30%, below its average 10-year PE ratio and 10% below. So, if you look at the negative bars on this, this is basically where the, money is cheap right now, or where things are cheap, right? Comparing the current PE ratios to the historical averages. We can see tech trading below its 5-year average. Communication services trading below its 5-year average, consumer discretionary trading below its 5-year average, utilities, real estate, energy. These are all some areas that you guys can potentially be looking for some long-term investments in, right? Because their valuations are below, some periods where we've seen them. Now, oftentimes, valuations can be a little tricky when things are quote unquote undervalued. Oftentimes it's for a good reason, right? Maybe there's a reason why this thing isn't really trading, at a certain valuation. And when valuations are really high, oftentimes there can be a reason for that too. Well, why are people, continuing to invest in this company and drive valuations higher, even though it's so much higher than, let's say, what it historically is or what people think it should be, et cetera. So valuations can get tricky, but there still is some good opportunities in the market, I think. All right, now, if you look at market cap weight versus equal weight, we can see which ranking tells the real story. And energy has actually been, really performing well here, right? If you look, the cap weighted and the equal weighted are both the top performing here. So that's really interesting to see. And when you go ahead and you take a look so this is the leader, right? Energy's been a leader. When you look at the laggard, tech, consumer discretionary are both leading to the downside on both market cap weighted and equally weighted sectors, right? So we're seeing just some confluence, right? Energy is really performing well this year. It'll be interesting to see, in 2022, energy was doing really well while big tech stocks were doing very bad. This, just the data just shows that that's potentially what we could be due for again this year. And when we took a look at those valuations, it's potentially obvious, right? Potentially obvious why people are piling into energy if they're so worried, about valuations and buying, expensive things in the market. Energy is a place that is quote unquote, cheap right now, right? Trading below its 5 and 10 year average PE ratio. And coincidentally, it's the top performing sector, both on a market cap weighted and equal weighted sector basis, right? If you take a look at the sector returns, okay, it's pretty much all multiple growth and energy. Okay, the EPS growth is actually slightly negative, right? Negative 0.1%. So it's not like we're seeing huge EPS growth, or earnings growth in the energy sector. It's all multiple growth essentially right here. Okay. Now, what are some other interesting things right here? So EPS growth is up about 2% in the S&P 500, but we're down, at the time that this data was put out, right around 5%. So the PE slash multiple growth has been negative, right? So we're seeing multiple contraction. You hear these phrases, multiple expansion, multiple contraction. In energy, for instance, we're seeing multiple expansion. It's not really driven by earnings growth. And then here in the S&P 500, even though we have earnings growth, we're seeing multiple contraction now, right? So that's what's happening in the stock market, if you're not aware, right? Now, when you look at risk on versus risk off, the market's clearly been risk off, right? We've got our risk off ETF here, just continuing a very strong uptrend, right? just looking really good, right? I mean, this chart looks nothing but bullish. And the risk off, or I'm sorry, the risk on ETF is actually making new 52-week lows, right? So the year-to-date change was over negative 9.5% on our risk on ETF, and the year-to-date change on our risk off ETF is up over almost 16%, right? It's at 15.83%. So huge, huge difference, right? In terms of performance, and the market is still just in a risk off environment. There's many ways to see it. That multiple contraction chart can tell you that. This is a really nice way to visualize and keep track of that there as well. The percentage of stocks above their 50-day and 200-day moving averages have both dropped below 50%. This was something really important in one of my previous videos that we put out, was hey, we're dancing here right around this 50% mark. If the stock market's going to rebound from here, we need to see this go back into an uptrend and start trading above 50%, and that's not what we got. Now, this is a really important chart right here as well. Kind of just revisiting some of the previous ones. We had this top formation in the SPX, and then we had this bottom formation in our credit spreads. Now, these two are going to move opposite each other, right? So you see this sharp decline in the stock market, and then you see this sharp rise here in the credit spreads measurement. This is basically you can justify moves in the stock market whenever you're seeing this measurement move in the exact opposite way. And that's exactly what we're seeing, right? We had a clear base, break, retest, continue higher. So, is if this measurement IAF divided by LQD is going to continue rising, then it's very possible we're going to see the stock market continue to head lower. The market looks very defensive right now. The discretionary versus staples is rolling over. High beta versus low volatility stocks is rolling over. The credit spreads are rolling over, and biotech is also rolling over. And we're just seeing that, economic expansion is just being, continuing to be priced out of the market, and contraction is just in an uptrend, right? Contraction is actually positive on the year, whereas expansion is lower, right? So the market is telling you, what it's pricing in, and it's definitely pricing in less and less economic expansion. Now, these are some areas that we want to see some improvement in terms of, bullish outlook, right? We've got growth versus value, right? So we've got the Russell 2000 small cap growth versus value, and then we've got big cap, large cap S&P 500 growth versus value. We had a negative divergence on these that led, before we had the sell off in the S&P 500. And so now we want to start seeing if we can get some bullish divergences in these, right? Can these start to make higher lows? Are these going to just continue their downtrend and continue to make lower lows? The equal weight is still outperforming the market cap weighted. And the reason for that is, obviously because of big cap tech, right? Big cap tech is such a huge weighting in the S&P 500, market cap weighted, that is, that it's dragging down the performance. And we're seeing some other sectors just, slightly positive on the year, or either just not as down as much, right? So we broke this very long-term trend line here, maybe like a 2 or 3 year downtrend, and we're consolidating above those levels now. So if this chart's going to continue to go up, essentially you're just going to see, this means that the average stock is doing a little bit better than big cap tech stock. Okay, is essentially what that means. Um, Now, it doesn't necessarily mean that the equal weight is going to be positive and the market cap weighted is going to be negative. It just means that, it could be going down less, right? So in terms of less volatility, you may see less volatility in the equal weight. If we are going to get this 10, 15, or I'm sorry, this 15% correction or more, one thing I'm looking at for an as a reason to really load up on stocks is the NYSE advanced decline line. If this number drops down to about 37,000, then that's an area where, a very logical place for buyers to step in, right? It's a Fibonacci price target, resistance here, could potentially be support right there. If we come down and continue dropping lower in the market, this is an area where I'm going to start buying some more stocks a little bit more aggressively, versus I am buying things right now, but just maybe not as aggressive as it would be potentially in the future. Commodities looking really interesting. Okay. This is the DBC right here, the commodity index, and we see, it's testing demand, testing support right here. And we're seeing inflation expectations, kind of breaking out here, right? Break or we have resistance and then support. So if commodities are going to go higher, it's very simple, right? Commodities are just tracking the price of things. If commodity prices go higher, then it makes a lot of sense for inflation expectations to go higher as well if people think the price of things is going to go up. And when we take a look at commodities, we see gold leading the way. So gold typically breaks out first, and then copper follows. Copper's following now, making new 52-week highs. And then oil. Oil is the one that comes next, right? So we've seen the breakout in gold. We've seen the move now in copper following through, and oil potentially could be one of the ones to rally here, some either sometime soon or later in the second half of the year potentially. Who knows? But that's definitely something that I'm watching and looking at energy stocks. We're also about to enter the best month of the year for crude oil futures in terms of seasonality, right? This is March where we're at now, where we've been, and then look at April. This is the best month in terms of seasonality for crude oil futures. And again, when we revisit energy, it's one of the ones that's trading below its 5 and 10 year historical PE averages. So XLE is something I've been buying. There's also been some really nice energy plays and energy trades. We had some trade ideas on multiple different energy stocks in the investment intelligence Discord. And some of those are doing pretty well also. And again, when you take a look at copper futures, all right, we talked about gold leads copper, and then copper leads oil. And you can see this that the copper futures and the XLE have very similar price movements, all right? And they track pretty similarly in terms of performance, in the way they look, right? So we're seeing copper futures hitting new 52-week highs, hitting new highs right here, but energy stocks have not followed yet. So people are wondering, when energy could follow, when oil could follow, potentially some of these other commodities, right? And if you look at XLE, it looks very clean, right? I mean, this is a huge two-decade, multi-decade base right here formation that we've got consolidating up at the highs. We've got a bullish pattern in a time of volatility compression, right? And so this is our volatility compression indicator on the bottom here. You see last time we were at lows, we had a bearish pattern forming after like a bearish continuation pattern, right? An ascending wedge, or I'm sorry, a rising wedge right here, or a bear flag, whatever you want to call it. But the point is, we came down, the trend was bearish, we were already dropping. Then we formed a bearish pattern here at a time when we had hitting lows in terms of volatility. And then what do we see? We see continuation to the downside. We see that bearish pattern play out. Well, here we've got the exact opposite, right? We've got an uptrend. So now we're coming into this with a bullish trend and a bullish pattern, an ascending triangle, which is a continuation pattern. And what's the trend before? It's bullish, right? And now we're at an all-time low in terms of volatility compression. So I really like this chart. I really like this setup. This is one of the reasons I've been buying XLE on top of the reason that I was going over before in terms of the historical PE ratio and the averages. Now, this is another chart right here. Okay, so we were looking at some monthly charts before. This is a weekly. We've got 4-month resistance trendline breakout. We've got a 1-year base formation. We've got a rising 200 moving average right here. All right, we've already gotten a bullish MACD crossover, and now we're wondering, is a momentum breakout going to be next on an RSI? So, nice setup there in energy. Now, another, area of commodities that I'm looking at is going to be agriculture. Okay, you can see this trend line here. We've shown this one before, but we bounced off at 1, 2, 3, and we're right here testing it a fourth time. I'm wondering if we're going to break through this zone, right? And what's going to happen if we do break through this zone, or if we bounce off of this level here. And it's going to have an impact on bonds, okay? The agriculture index, DBA, tends to move opposite of bonds, right? They have an inverse relationship with each other, and that's very evident on the chart, right? You can see as bonds are going up, agriculture is going down. As bonds are going down, agriculture is going up, and we've had this extended period here where there have been, bonds have just been continuing to go down, and agriculture is continuing to go up. So if this trend line breaks right here, and we actually see agriculture start to go down, that could be potentially a bullish tailwind for the TLT, right? And bonds look pretty interesting, right? You look at 30 US 30-year bond futures. These look like those could potentially break out here, right? We've got a very long-term downtrend. We're approaching those levels right now. We've got a potential base formation here, right? I mean, this kind of looks like an inverse head and shoulders, if you ask me, right? Here's your left shoulder, your head, your right shoulder, boom. If this plays out, if that inverse head and shoulders plays out, then we could potentially see US 30-year bond futures break out. And those tend to trade well and move very similar to the Japanese yen, right? And there's lots to talk about the US dollar being weak right now, so that's going to mean strength in other foreign currencies. And foreign markets and foreign investing is just a very big theme right now so far this year. So if we see the yen and 30-year bond futures break out, it's very possible that we're seeing this agriculture chart right here in DBA breaking down. So that's something I'm watching. We've also got a potential inverse head and shoulders in the bond market via TLT and IEF. IEF is probably the cleaner one versus something like TLT. But when you look at this ratio chart here of TLT versus SPY, we're starting to see a shift, right? Now we've gone through these periods before, and then things have just rolled over, right? This is going all the way back to the pandemic, and we're finally breaking out of this trend line here. Basically what that means is, if this line is going up, it means that when TLT is going up, it's out, or when this ratio chart is going up, it means it's outperforming the S&P 500. And those two have had, a little bit of an inverse relationship, right? If you go to the beginning of the year, for 2025, we can see the S&P 500 is making lower lows, lower highs, and TLT is making higher lows and higher highs. Now, the weekly chart is still very messy, okay, and there's still a lot of work to be done in TLT. We've seen many head fakes over the past couple years. For right now, I'm really focusing on the anchored VWAPs when it comes to a longer term outlook. Yeah, there's some shorter term trade opportunities in TLT all the time that you guys can take advantage of. But if you're looking for, a longer term time horizon, we really need to reclaim the anchor VWAP from here, which is the 2022 highs, and then the anchored VWAP from the lows, from the bottom in TLT in 2023. Okay, and you can see both of those are trading just above our Fibonacci retracement level of 92.83. So let's just call it 94. Okay, if TLT can reclaim this anchored VWAP and both of those anchored VWAPs and start trading above 94, closing above there on a weekly basis. Well, that's going to be really important, right? Because using the anchored VWAPs lets you know who's in control of price. So when you're trading above those, it lets you know that the bulls are in control of price action. Right? But we've had many failed breakouts above that, right? We had failed breakout here, failed breakout here, and now we're trading below those. So, these are flattening out. They're slightly declining, but they're not, aggressively declining. They're trying to flatten out. For long-term outlook on TLT, that's what we need to see. We need to see it closing on a weekly basis above 94, reclaiming those anchored VWAPs because there's still lots of resistance, right? And there's still a lot of work to do to repair some of the damages that we've seen in the TLT, right? I mean, if we take a look at this long-term trend line here, we have support, we have support, we have resistance, and we're still trading a good amount of distance away from this important trend line here. So even if we do get a rally and we get up past 94, this 96, 95 area here is going to be where this trend line is at. And if we can break out from there, then that'll be the first time in years that we've actually started trading above this range and above this downtrend. So that's some things I'm looking at. Now, shorter term, okay, we've got the anchored VWAP from the recent pivot highs and the anchored VWAP from the recent pivot lows, and they're pinching right now. Okay, prices, essentially pinching between these. And dancing around. We call this the VWAP shuffle, where buyers and sellers are really just fighting for control, and ultimately this is going to resolve higher, right? We're either going to be trading above both of those anchored VWAPs or lower than both of those anchored VWAPs, and that's going to tell you most likely the next direction, the next place that TLT is heading. We're trying to form an inverse head and shoulders right here, with our neckline looking something like this right here in this blue trend line. But if TLT is trading above 91.29, then bulls are going to be back in control, and we want to see them hold that, break this neckline, and our next move up, we're going to be targeting 95.24, okay, on the TLT. So that's what I'm looking for in a little bit shorter term, is for a reclaim of 91.29, break this trend line right here, and look for a move back up towards 95.24. Now, as always, the content provided on this channel is for informational and educational purposes only, and is not intended to be relied upon as legal, financial, or investment advice. So, be sure to read through the disclaimer. And if you're new to the channel, I started a completely free newsletter for you guys called Investment Intelligence, giving out free, valuable finance and trading related content. I even put in some free trade ideas in there as well, so you guys can check out the website, read some of the previous articles, see if it's something you like. You can also join the Investment Intelligence private trading group using promo code Powell. That will get you guys access to the Discord. Inside of there, there's lots of custom scripts and indicator scans, right, based on these custom scripts and indicators. So if you're having trouble, navigating this market, those things will really help you a lot, right? Being able to fine tune a strategy, look for something that works for you, whether it's, looking for supply demand zones, right? And maybe you can't chart those. We've got a really good indicator in there that charts it up for you, and then you can, run the scan based off of that and look for stocks trading in demand, right? Or since we're in such a downtrend lately, you want to look for stocks trading in supply potentially to even short. There's lots of really great stuff inside of there that I think you guys will like. So, use that promo code Powell. That will get you guys a very nice discount on your first, your initial membership fee right there in the Discord. All right, this is the zone finder right here. I actually published the very first trade idea from the zone finder into the investment intelligence newsletter for free for you guys. You can see we had a bullish chart pattern here, a falling wedge, along with trading in our demand zone here, break retest of demand right here. And that trade worked out very, very well in a very short period of time. All right, so thank you guys for watching, and I'll see you guys in the next one.